How it's work? The NFIP is administered by FEMA, now parts of the Department of Homeland Security. Flood insurance was initially only available through insurance agents who dealt directly with the federal program. The direct policy program has been supplemented since 1983 with a private public cooperative arrangement known as Write Your Own, through which is a pool of insurance companies issue policies and adjust flood claims on behalf of the federal government under their own names, charging the same premium as the direct program. Participating insurers receive an expense allowance for policies written and claims processed. The federal government retains responsibility for underwriting losses. Today, most policies are issued through the Write Your Own program, but some non-federally backed coverage is available from the private market. The NFIP is expected to be self-supporting, i.e., premium are set at an actuarially sound level in an average loss year as reflected in past experience. In an extraordinary year as Hurricane Katrina demonstrated, losses can greatly exceed premium, leaving the NFIP with a huge debt to the US Treasury that it is unlikely to be able to pay back. Hurricane Katrina losses and the percentage of flood damage that was uninsured led to calls for a revamping of the entire flood program. As with other types of insurance, rates for flood insurance are based on the degree of risk. FEMA assesses flood risk for all the participating communities, resulting in the publication of thousands of individual flood rate maps. High risk areas are known as special flood hazard areas or SFHAs. Flood plan maps are redrawn periodically, removing some properties previously designated as high hazard and adding new ones. New technology enables flood mitigation programs to more accurately pinpoint areas vulnerable to flooding. As development in and around flood plains increases, runoff can change, causing flooding in areas that were formerly not considered high risk and vice versa. People tend to underestimate the risk of flooding. The highest risk areas, Zone A, have an annual flood risk of 1% and a 26% chance of flooding over the lifetime of our 30 years mortgage compared with a 9% risk of fire over the same period. In addition, people who live in areas adjacent to high risk zones may still be exposed to flood on occasion. 90% of all natural disasters in this country involve flooding, the NFIP says. Since the inception of the federal program, some 25 to 30% of all paid losses were of damage in areas not officially designated at the time of loss as special flood hazard areas. NFIP coverage is available outside high risk zone at a lower premium to prevent people putting off the purchase of coverage until waters are rising and flooding inevitable. Policyholder must wait 30 days before their policy takes effect. In 1993, 7,800 policies purchased at the last minute resulted in $48 million in claims against only 6,25,000 in premiums. Proposals of change. The NFIP has four major goals to decrease the risk of flood losses, reduce the cost and consequence of flooding, reduce the demand for federal assistance, and preserve and restore beneficial floodplain functions. In a final report published in 2006 by the American Institutes for Research (AIR), which conducted an evaluation of the federal flood insurance program, AIR said that although much had been accomplished, the program fell short of meeting its goals, in part because the NFIP did not have the ability to guide development away from floodplains and cannot restore beneficial floodplain functions when they have been impaired. In addition, AIR said many people still are not covered or not adequately covered for flood damage. AIR also noted that the NFIP was hampered in reaching its goals by insufficient congressional funding, lack of patent data, misperceptions about the nature of the program, and the breakdown in coordination among its three major sectors. A report published by FEMA in 2007 suggests that development patterns should be changed to protect environmentally sensitive areas, and that communities in the flood program should be encouraged or required to ban development in these locations. Another criticism of the NFIP is that it does not charge enough for coverage. Among the reasons for the premium shortfall is that the cost of coverage on buildings that were built before floodplain management regulation were established in their communities or is subsidized. As a result, the premiums paid for flood coverage by the owners of these properties reflect only 30 to 40% of the true risk of loss. In January 2006, FEMA estimated an annual shortfall in premium income of $750 million. Due to these subsidized, some subsidized properties also suffer repetitive losses. Repetitive losses properties accounted for about $4.6 billion in claims payments between 1978 and 2004. The AIR report acknowledged that the current system is not eliminating existing damage-prone buildings as quickly as expected. Insurance fraud. The Insurance Information Institute estimates that fraud accounts for 10% of the property casualty insurance industry's incurred losses and loss adjustment expenses, or about $3 billion a year. This fraud results in higher premiums. Fraud may be committed at different points in the insurance transaction by different parties. Application application for insurance policyholder, third party claimants, and professionals who provide services to claimants. Common fraud include padding or inflating actual claims, misrepresenting fact on an insurance application, submitting claims for injuries or damage that never occurred, and staging accident. Prompted by the incidents of insurance fraud, 41 states and the District of Columbia have set up fraud bureaus. Some bureaus have limited power and some states have more than one bureau to address fraud in different line of insurance. These agencies have reported increases on referrals, tips about suspected fraud. Causes opened, convictions, and court-ordered restitution. Insurance fraud can be hard or soft. Hard fraud occurs when someone deliberately fabricates claims or fakes an accident. Soft insurance fraud, also known as opportunistic fraud, occurs when people paid legitimate claims, for example, or in the case of business owners, list fewer employees or present in the work they do to pay lower workers' compensation premiums. People who commit insurance fraud range from organized criminals who steal large sums through fraudulent business activities and insurance claims miles, to professionals and technicians who inflate the cost of services or charge of services not rendered to ordinary people who want to cover their deductible or view filing a claim as soon as an opportunity to make a little money. Some lines of insurance are more vulnerable to fraud than others. Healthcare, workers' compensation, and auto insurance are believed to be the sectors most affected. Insurance fraud received little attention until the 1980s, when the rising price of insurance and the growth in organized fraud spurred efforts to pass stronger anti-fraud laws. Allied with insurers were parties affected by fraud, consumers who pay higher insurance premiums to compensate for losses from fraud, direct victims of organized fraud groups, and chiropractors and other medical professionals who are concerned that their reputation will be tarnished.